Greetings traders, and welcome back to another survival guide. Chris here, bringing you some more information that will hopefully allow you to progress further in your trading career, whether you're just looking to become a better trader or perhaps you're looking to pass the Gauntlet Mini. Today we're going to be discussing the top volatility-filled commodities markets out there that we feel are worth paying attention to. As being a trader goes, we do know that volatility and opportunity are hand in hand. We need that volatility to find those sweet opportunities, so it is important to be aware of which markets have that volatility. Now, without further ado, let's go ahead and dive on into the materials that follow so we can learn about which markets have the volatility and whether or not we want to invest our time in them. Bijou. Speculative traders thrive on volatility. Whether we're looking at crops, minerals, or even oil, it's often very surprising to traders when they realize how volatile commodities can actually be. But like any other investment market, the price usually is boiling down to a simple supply and demand issue. So identifying the markets that seem to have the most supply and demand issues generally goes hand in hand with finding markets that have more volatility. At first glance, it might be challenging for traders that aren't involved in the commodities markets to really feel like they should care about the volatility in the commodities markets. But the truth is, the markets are connected. A report by Oliver Wyman showed some very interesting information on how the volatility in the commodities markets impacts a variety of investment markets. One of these statistics that he published was that commodity price swings are the second largest driver of earnings uncertainty at publicly traded companies. And then also, he wrote about the fact that 23% of senior financial professionals consider commodities to be the primary driver of their earnings variability. So just understanding these types of connections, we can very easily begin to understand how our other investments, maybe it be a stock in a particular company, can have an impact or should be impacted by the volatility in the commodities markets themselves. Volatile commodity markets have been described by some traders as a trader's paradise, and there's quite a large number of reasons that should incentivize the trading of volatile commodity markets. The first is the mix of investors and traders does improve the liquidity. The more liquidity we have, the better we'll be able to get in and out of trades, so this is always a net positive. Then we have the increased liquidity allows the traders to deal in significant contract sizes. So because the market is so liquid, we can get a very large number of contracts opened and closed in a relatively short period of time. And next, commodity markets do tend to be more transparent and influenced to a lesser extent by government activities. So if you don't like the sudden fluctuations caused by government reports, well, the commodities markets aren't so prone to those movements. Then we have the constant dealing by arbitrage, who will quickly subdue pricing anomalies. This means that because of the arbitrage coverage, there will be less crazy anomalous swings that occur because it'll be brought under control relatively quickly. Volatility, of course, is also important in futures. The traditional measurement of volatility is standard deviation around the mean of an asset price and the average of an asset price. If a commodity price is relatively close to the mean or average, then the standard deviation is relatively small. The highs and lows of the price deviate significantly from the mean average, indicating relatively high volatility. In theory, the higher the standard deviation, the higher the potential investment return. That is the perfect scenario for many futures traders. The leveraging effect of options and futures contracts on a relatively volatile commodity can create a very precarious situation. The greater the degree of commodity price standard deviation, the greater the effect of leverage on the options or futures prices. It is extremely important because of this to be very careful careful because we can magnify those negative swings when we're not paying attention. It's also vital to realize the low to negative correlation between traditional stocks and bonds and commodity prices themselves. While the macroeconomic outlook will impact the investment markets to a certain extent, commodities have different influences than stocks and bonds themselves. And consequently, you can effectively trade in two very different investment markets due to the lack of direct correlation. To give ourselves a better sense of understanding around the relative volatility in the commodities markets, let's take a look at various asset classes here where we can see their quarter volatility range. And as we can see, starting off at the top, the E-mini S&P 500 had a 5.35 to 27.23% volatility range, relatively stable by most people's standards. Then when we work our way down to something like, say, silver at the very bottom, look at this range here. We go from 10% to 100%. We have a very, very wide range, a lot larger than the, say, 22% or so range of the E-mini S&P 500. The type of volatility has been very different depending on the market of which you are taking a look at in the commodities world, but the point is this will give you some of the most common and most popular commodities markets that have a very reasonable quote-unquote volatility range that is attractive to many traders. So all of these markets are attractive to the right trader, but it's up to us to figure out which type of volatility best suits our personal risk tolerance. When it comes to the king of commodity volatility, Bitcoin does try to set itself out from the pack. Look at this chart. It is just absolutely insane. In 2014, that's when this chart begins. It's only a few years, relatively speaking, of data, and it stops in present time at 2021 at the recording of this video. And we can see that in 2014 to 2021, we saw a rise of over $65,000 in value, being close to near $0 in 2014, relatively speaking, to almost $65,000 in 2021, before whipsawing back down to somewhere around the $40,000 to $35,000 mark as present day. The volatility is undeniable. The swings are in the thousands of dollars, and it's really hard to find any other commodity that behaves as erratically as Bitcoin does. Now let's take a look at one you may not be expecting, and that is cotton. Cotton is indeed known for its volatility. This is a 45-year chart, so covering a lot more time here than the Bitcoin chart. And because of things like global stockpiles, government policies, global demand, climate, substitutes for cotton itself, oil prices even, and the value of the US dollar, we have watched the prices of cotton go up and down erratically for a very long time. This is definitely one that you're going to want to pay attention to if the volatility interest or the volatility bug has bitten you. Then we have soybeans. Soybeans, a staple of our economy, is actually one of our most volatile commodities that we can trade. Its chart doesn't look too different from cotton at a first glance. This is a chart that covers roughly the same amount of time. It goes back to right around 1970 to presently right around 2021, 2020. And with this, we can see that price has been quite erratic. But once again, when we put it in comparison in terms of actual currency numbers that have changed, meaning going from $4 to $6, it is still hard to compare to Bitcoin going from something like $0 to, say, $65,000. So nothing is really going to compare to that. So we have to look at the path itself and look at percentage gained and loss and take that into consideration when measuring volatility. Crude oil is another one that is an extremely volatile commodity, and this should really come as no surprise. As we run into, say, OPEC policy changes or a disruption of the supply like we just had with the hacking of the pipeline in the US, or global warming, or the politics surrounding the oil itself, whether it's something correct for us to do morally or whether it's something incorrect for us to do, how is it impacting the weather? All of the different things that you could possibly think of do impact affect the price of crude oil, which does make for a very erratic field at times because not all of those factors do coincide and correlate perfectly together. So crude oil, another very high volatility type of asset if you are looking for a commodity that does express its volatility on a daily basis. Some other noteworthy mentions as far as a very volatile commodity goes, we have silver, we have gold, we have sugar, and we have coffee. On one side of the spectrum, we have the precious metals, silver and gold. These are always going to be extremely volatile because their value does go up and down almost inversely to currencies that are not stapled to them. Then we have sugar and coffee, where all of a sudden a quick shift as far as a trade agreement between two countries, as far as exports and imports go, could very suddenly cause an erratic price movement in either of those if it is impacted. So sugar, coffee, gold, silver, it doesn't matter if it's crude oil or what it is that you decide to trade. But as with all things, we strongly recommend checking it out for a long period of time before you actually execute any trades based on a strategy if it was built on a previous asset. Use that demo account to your advantage and practice before you go live. But until next time, thank you for joining me as always, folks. Best of luck in the markets. I will see you all very soon. Don't forget to hit that like and subscribe button down below so I can keep coming out with content for you all. And I will see you soon. Over and out, bye, guys and gals. Everybody.